Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Weekly Update for the week of July 20th. My name is Fritz Folts. I'm the Chief Investment Strategist here at 3Edge. And on this week's edition of the 3Edge Weekly Update, we have a special guest. Pleased to be joined here today by Eric Biegeleisen, Director of Investment Research here at 3Edge Asset Management. Eric will provide a summary overview of the workings of our proprietary 3Edge Global Capital Markets research model. And this idea is actually in direct response to many of our YouTube subscribers who have asked us to provide an overview of our research process. But first, let's get caught up briefly on the global capital markets for the week. So equity started the week with a strong couple of days in the midst of seemingly positive news about vaccine development. But by the end of the week, markets had given back much of those gains, beginning with this week's jobless claims report that showed that the number of people filing for unemployment benefits grew to almost 1.5 million. In addition, new cases of coronavirus in the U.S. continued to surge higher, placing in doubt the capacity for the U.S. economy to recover anytime soon. Investors are also focused on Washington, D.C., where Congress is currently negotiating the next round of enhanced jobless benefits, which are set to run out at the end of this month. So for now, it seems like we may be in for a period of what I would call sideways chop, up one day, down the next, and oftentimes driven by news on the prospects for a vaccine for COVID-19. So now let's turn our attention to providing an overview of the 3Edge research process, and for that, I'll bring in Eric Biegeleisen to take us through the 3 edges of our approach to researching the global capital markets. And perhaps, Eric, you could just start with a brief overview.
Sure. Yeah, thanks, Fritz. So there are 3 edges to our investment research process that combine together to help provide us insight into the likely direction of the broad-based macro asset classes that we model. The combination ultimately provides us a set of projections for each asset class. So I'll walk through each of these at a high level, and then we can dig into the details, if that's all right.
That sounds perfect. It's all yours.
All right. So we utilize valuation factors, which are longer term in nature, on the order of many years and decades. Much like conventional approaches to valuation, this analysis is seeking to identify long cycle mean reversion behavior, though unlike more conventional measures, we have constructed our own estimates for each asset class's valuation. Next, we look at medium-term global macroeconomic factors on the order of months or a few years. Rather than examining more traditional government-furnished data, which is by definition lagged or old, these factors we've constructed primarily rely on market-driven data, which we believe is the best leading indicator of where investors see value in the marketplace. And finally, we built this comprehensive set of investor behavioral filters that focuses on the short term, on the order of a month or two. We can do what we believe is thoughtful and thorough analysis on each asset class we model from a valuation and economic perspective, but as we have all likely experienced from time to time, the market can behave in seemingly irrational ways. And this set of investor behavioral filters helps to identify when these behaviors may be present and to correspondingly update our asset class projections to reflect the possible regime changes.
Very good. So now maybe let's just take a look at each of these 3 components of the research process, one at a time, and beginning with valuation.
Yeah. So as I mentioned, we're looking at longer cycle phenomenon with our valuation approach. This helps set the stage or provide a context to the type of environment that a particular asset class is in, a starting point. Often more conventional approaches look at price to earnings or PE ratios, which have become this accepted barometer for how fairly priced a stock is. A low PE may indicate undervaluation with the potential to rise, with the opposite being true as well. This type of thinking assumes that there is this inherent mean reversion in prices. That is, if it's undervalued, then given enough time, it will come back to fair value or swing to overvalue, and vice versa. At 3Edge, we agree with this idea of mean reversion behavior, though we believe PE ratios themselves may be a bit limiting to complete the full picture on valuation. So first, we need to establish an equity risk premium. That is, this expected rate of return an investor should be compensated with for taking the risk of owning equities. We derive this using an earnings discount model that adjusts for share buybacks and dividends. Next, rather than just earnings, which can be manipulated through accounting tricks and restatements, we like to look at sales and earnings margin. Sales are not as easily subjected to these accounting tricks. But looking at sales and earnings margins alone still isn't enough. We have to also acknowledge a few other items in our analysis to account for the environment in which these companies operate, specifically the prevailing and expected interest rates, that is the cost of capital, as well as the current and expected growth rate. Once we adjust the earnings margin for cost of capital and implied growth, we can arrive at a new fair value for the index we are modeling and then compare this against the prevailing index price to arrive at this level of under, fair, or overvaluation for each asset class that we model.
Excellent. And now let's take a look at some of the global macroeconomic factors in the research process.
Sure. Well, yeah. So after establishing the context of valuation, we next examine the global macroeconomic factors, which play this medium-term role. Shown here are just a couple of examples of factors we employ. First off, we examine credit spreads. That is the difference between the prevailing interest rate for investment-grade corporate bonds or high-yield bonds compared against the risk-free rate of U.S. Treasuries. And it isn't the absolute level of the spread that is of interest to us. Rather, it's the rate of change of these spreads. Tightening spreads are indicative of companies' ability to take on more projects that are more likely to be profitable given the lower cost of capital relative to their present-day position, while widening spreads would indicate the opposite. Another factor that we believe is incredibly important is the yield curve slope in each economy that we're modeling, though we make things a bit interesting here. First, and just to review, the idea behind this factor is that all things considered equal, a positively sloped yield curve is indicative of future growth in an economy, while the opposite is true. So how do we construct this factor? So we start by comparing the 10-year bond yield with the 3-month bill yield on a lagged or historical basis, as it takes time for changes in interest rates to manifest their way through the economy and ultimately into earnings. Also noteworthy and particularly relevant in today's world of unprecedented stimulus is that we have quantified the effects of each central bank's balance sheet expansion or contraction, if it ever happens, on their effect to the prevailing Treasury bill yield. So we're adjusting our bill yield measures up or down based upon this stimulus and analysis to gain a truer picture of the growth potential. Beyond the lag and the central bank accommodation, we also account for a credit contractionary environment or liquidity crunch, as we saw in the global financial crisis of 2008, where investors pile into shorter-term Treasury bills. This type of investor response has the effect of steepening the yield curve by driving short-term rates down, which would indicate an actual positive outlook. Though, as we know, this is the exact opposite signal one would want in this type of environment. So to account for this, we adjust our yield curve measure by the prevailing TED spread, which is the difference between the yield on loans banks charge one another and the Treasury bill yield. As this spread widens, as it did in 2008, and as it would in a liquidity crisis, when everyone wants to hoard cash, this addition will have the effect of making our yield curve measure look inverted rather than positively sloped. We also separately examine the rates of change of the 10-year bond, the 3-month bill, the yield curve measure itself, which include nonlinear thresholds where the behavior of a factor can change dramatically, much like water changing from a liquid to a solid or gas at discrete temperatures. Rates can behave in a similar fashion. There are many other economic factors in the model, but hopefully these illustrate the type of logic that goes into our macroeconomic edge.
Excellent. And so lastly, we'll look at the shortest term measure of the research process, and that's investor behavior.
Yeah, so as we discussed earlier, you can do all this extensive work establishing the level of valuation and the impact of a variety of global macroeconomic factors, but sometimes shorter term, there may exist investor behavioral phenomenon that just overwhelm all this analysis. And so to account for this, we established an investor behavioral framework to modify the combined valuation and economic projection if any of a number of behaviors are present. The idea here is to provide a context-sensitive framework based upon the level of valuation as well as that economic backdrop. So we do this by classifying the level of investor psychology into one of 5 camps: overbought, a rally mode, more neutral environment, correction mode, or an oversold condition. So imagine an equity index that is undervalued and positive economically, but is in an overbought condition versus being in an oversold condition, the two extremes. Given that backdrop, the model is likely to heavily favor this asset class in an oversold condition, while in the overbought condition, despite the positive nature from the valuation and economics, it is likely to be much more cautious. Beyond this analysis, we also seek to identify conditions where equities are likely to sell off shorter term. We've termed these conditions canaries or our canary filters. Things like sharp changes in inflation through a variety of measures, sharp changes in certain currencies, sharp changes in key credit spreads, etc. When one of these canary filters trips, it bypasses the rest of the behavioral filter and may have a dramatic effect on the final asset class projection by attempting to ensure that we keep it out of the portfolio. So,
Excellent.
yeah, so I mean, that's a high-level overview of the 3 edges of our model. And again, all these combine together to ultimately produce a 1-year forward projection for each asset class that we update monthly. We then use these projections directly to build the set of corresponding allocations for each portfolio strategy.
Great. That's really helpful, Eric. So I was thinking that maybe one thing that could be helpful, sort of to tie all of this together. If we were to look at one particular asset class, let's take US equities. And if you could perhaps give an indication that's saying, okay, what is the model saying right now about US equities in terms of valuation, economic fundamentals, and investor behavior? So sort of tie it all together.
Yeah. Well, so I'll work backwards. Behaviorally, the US is in this rally mode, and on its own would generally be a positive thing. However, the US equities are also highly overvalued, something we've been discussing on the View from the Edge for some time. But still, on net, they're positive economically. So the behavioral framework therefore takes an otherwise attractive combined valuation and economic projection, and despite being in the rally mode, actually haircuts the projection down, though it still remains positive overall. So there's a balancing act between the three.
Yeah, that's absolutely true. It is. That's a very U.S. equities are a very good example of they're not at the extreme of one end or the other, and that's actually reflected in our allocation currently. So, anyway, thank you, Eric. Thanks for that overview of the process. We hope that everyone has found this to be helpful and informative. We certainly think that it's useful for our clients here at 3Edge to have an understanding of our investment process. It's important for us to be transparent in terms of what we do and how we do it. So that'll do it for Eric and me. Steve Cucchiaro and I will be back next week with another edition of our 3Edge Weekly Update. Remember that all of these videos are available on our 3Edge YouTube channel, which you can feel free to subscribe to. And please feel free to share these videos with anyone who you think might be interested. In addition, if you have any questions or suggestions for a future topic, please feel free to send those along to us at our website, 3edgeam.com. And on behalf of Eric and everyone at 3Edge Asset Management, we urge you to remain safe and healthy, to stay strong, and to keep the faith. And we thank you for listening.